Right, let me go to the gold chart because there is a really nice VPA example on there that I just want to show you. Where are we? Here we are. And I want to show you this for several reasons, not least because it highlights facets of volume price analysis. It highlights the fact that VPA applies to any market you care to consider. This could be any chart. It could be a stock. It could be a commodity, which it is. It could be a future. It could be an ETF. It could be a cash stock. It could be Forex. Could be anything. Could be a currency future. Could be spot. Doesn't matter. What I want to highlight here are several things. First of all, some really, really nice VPA lessons, of which this is one. If I pop this one up full size, you'll see what I mean straight away. This is us 1:30, so you know, this is getting underway, lunchtime-ish our time, US markets opening up, etc., etc. We get a nice volatility trigger. It doesn't follow through on this occasion, but then what do we get? We get high volume, even higher volume on the next candle. Big wick to the upper body. What is that telling you? It's telling you there's weakness around. You can't have that much amount of volume driven into this much amount of price with that at the top of it and not expect some weakness to deliver. It doesn't come on the next candle, but the volume falls away dramatically, which is telling you, yes, there is weakness here. There's heavy selling going on in this candle. We get these two candles, 2-bar reversal, and then off we go. We start to go down. But what I want to show you is this. This is a price waterfall. It's a classic price waterfall. We've got weakness confirmed here. We've got weakness confirmed again. Then we've got rising volume. There was straight through candle, no wicks, great stuff. Then we start to see the stopping volume coming in. This is buying. It cannot be anything else because you've got a deep wick to the lower body, a ton of volume coming in, but it doesn't stop there because we get it on the next candle. And then we start to see 2 candles later, the fact that that selling pressure, that heavy selling pressure has been absorbed by the market. Why has it been absorbed? Because this candle here is sitting in the same price area as this candle. So if you're seeing this amount of selling in this price region, and yet when you move 2 candles forward, you see this amount of selling, what is that telling you? It's telling you that that selling has pretty much been absorbed. In other words, it's been soaked up. And that's what stopping volume is all about. Sometimes, occasionally, you will get this, you'll get one of these, and then the market will just take off straight away, and you'll get a V-shaped rally. It happens. You just have to pass them by and say, okay, on that occasion, it did that. You know, I'm not going to jump in straight away, because generally speaking, typically, this is a classic example of what happens. You get the price waterfall, you get the stopping volume coming in, tons of it. I mean, you cannot miss these signals. These are so straightforward, into the congestion phase, and then we come out the other side and into the rally that's now developing. It's just a perfect example of what to look for. Very simple examples. It's not sophisticated. It's just a very simple application of volume price analysis and what you're looking for the whole time to take low volume low risk trading opportunities. And that's what these are. And that's what VPA does for you. Yeah, can do. Sorry, Anna says there's a question just come in. Okay, let's have a look. When comparing candles, their associated volumes with each other, do you include the wicks in the candle size comparison? Absolutely, because the wicks are the most important aspect of the candle, bar none. You look at a candle like this, yep, fine, it's an up candle, good volume under it, minor wicks top and bottom, that's fine. But when you get these wicks to the top of the body or the bottom of the body, doesn't matter, those are the important things to consider, because they are the anomaly candles. They are the candles which will reveal weakness, whether you've got strong buying, strong selling, lack of participation, whatever it is a trap move, is it a trap move with a big wick, no volume, etc., etc. When you're actually comparing candles with candles and you're looking at equal size candles or equal shape candles, for example, you're in an up move, so you're looking maybe at this candle, you think, okay, well, I want to look at this candle and I want to look at this volume. You then go off and look at comparative benchmark candles of a similar shape, and you're looking to say whether the volume that you're associated with that particular candle is in line. Is it higher? Is it lower? What is it? So you're constantly looking for benchmark candles to give you some comparative basis on which to judge whether the candle that you're looking at is about right. Is it out of balance or is it in balance? It's as simple as that. It's a very simple way of doing things. You're constantly looking at these candles, narrow spread, wider spread, what's the volume like, what have I got over here? But you've also got to remember that you can't cross over sessions. So wherever you are in a session, you've got to compare volume with volume in that particular session. You can't hop over from one session, in the UK and look at volume in Asia, for example. It doesn't work like that. You have to look at the volume, comparing it within the session itself. And then really you step down onto the other timeframes, and it's just the power of multiple timeframes which then comes into effect. Sorry, one other thing I wanted to show you on there was also the, just bung that down there, where were we? 10-minute we were on, weren't we? There we go. The other aspect to it, which is another facet of volume price analysis, is support and resistance. We had this level here which came into play. This is an extremely strong level. This is on the accumulation distribution indicator. I referenced it earlier on. What it does, very simply, it paints these levels in terms of their strength through the thickness of the line. So the thicker the line, the stronger those regions. So when you've got two like this, you've got a very, very strong platform of support coming into play. So when you see something like this, you've got your VPA, you're seeing the buying coming in, you're starting to wait for your breakaway, you get your breakaway on good volume. Don't know where you get in, you'd be looking maybe at a slightly faster time frame, maybe on a 3 or a 5 minute. You'd certainly be in here somewhere or the other. Then what you're looking at is, well, where am I going to place my stop? Would you place it below here? If it fits your money management rules, fine. That's a 10-ounce stop loss. That's big bucks. You might want to go tighter than that. You might want to go in under here somewhere. But you're always looking at those sorts of levels for potential regions of stop loss. We go down onto the 15-minute. It's a different picture, but it tells the same story. Big volatility candle, expect congestion, got it, reversal, rolls over, volatility, expect congestion, got it, buying coming in, more buying coming in, diminishing, selling pressures diminishing, fine, off we go. Weakness came in here, didn't deliver. We got a doji candle, decent volume, but it's it's indecision at that point. You might be thinking, well, is this market going to roll? It hasn't. It's continued on higher. We have got weakness here. We've got a little bit more weakness here. It's still carrying on higher. If the market's going to break higher still, we need to get through this region here because we've got a ton of volume sitting here. If once we get through 24 and 25, then we should be good to go and away up into higher reaches. This is on the 30-minute. Exactly the same principles there again. Big volume, volatility, big volume, buying, and on up we go. And as I say, if we get up to 25, 26, and when you get to the top of a chart and you run out of headroom, if you will, you move up to the next time frame. So I'm now on the 30-minute. I'm looking at what's ahead in terms of 30 minutes. And as we get to $25 and $26 an ounce, then through here, progress should be pretty straightforward. Why? Because you've got very little in the way of volume to act as a resistance to that move higher. So I just wanted to highlight that on the gold chart. It's just a nice little VPA example just coming here over on 3-minute. Let's pull that down a bit. This is all distorted, of course, by this volume over here. This is 3 o'clock, so this is 2.5 hours, nearly 3 hours. But if I extend this out and get rid of those there you go. Now you're back into a little bit more descriptive nature. So when you see little candles like this, what are you expecting? You're expecting a bit of weakness. We've got weakness here. We've got a wick to the upper body, decent volume, bit of weakness, congestion. Doesn't mean the market's going to roll over. There isn't a huge amount of selling, but at least if you're trading this and you've got a decent number of contracts on, you're anticipating what is going to happen next. Am I expecting this market to rocket higher? No, I'm expecting some congestion, possibly a pullback. I'm quite comfortable with that. If I see buying coming into the market and support, which I'm starting to see now under this volume here, if this candle closes with a wick and maybe closes higher, in other words, the buyers have stepped back in again, that's fine. I'm cool with that. But if I see maybe a decent widespread down candle developing on high volume, then maybe it's time to either close out completely or at least remove some of the contracts from the position. In other words, scale out and leave a couple of contracts to run or one contract to run and take 3, 4, 5 off the table, however many I've got running. And that's really what VPA is all about. It is giving you the confidence to make decisions based on logic and on common sense and analysis. That's why it's called volume price analysis, and not based on a gut reaction to fear of losing a profit that you have, which is the biggest fear of all. And it's the biggest problem that every trader has to face, because if you can't make big wins and you're constantly filling your account with small losses, but you've also got small wins, your account is going to go sideways or down slightly continuously. It's not going to move forward. And that's the issue. And that's what VPA does for you. And then, of course, you have all the indicators to support you. You can see the trend monitor at the bottom here, bright blue, helping to keep you in. It's bright blue here on 3, on 5, on 10, on 15, on 30. On the daily, we're still a little bit bearish. We've come out of this. We had this peak at trying to get through 1800, couldn't make it, still trying to rally. So on the longer term perspective, it's a little bit bearish, it's weak. But in terms of an intraday, certainly from an intraday perspective at the moment, we're still bullish on and rising into this trend at the moment. Just going to pause there for a moment